me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But cheer up! And stay small, stay humble, focus on the long term, never risk money you cannot afford to lose.
There we go, that should work. Hey, my name is Wayne. Welcome to the ECB press conference. We're just going to watch it together and see how it goes. In the meantime, if you feel like clicking links, in the description below today's video, you'll find a link to my book, Strategic and Tactical Forex Trading, a link to my community, fxbootcamp.com, and a link to tradersway.com, an ethical, trustworthy foreign exchange broker that would like the opportunity to earn your loyalty and respect. They've earned mine. Open a demo, maybe they'll earn yours. And we all need a broker. Tradersway.com. And there, the microphone should be here. Yep. And look at that, perfect timing. Walking on, maybe? Is that them? I'll share the link.
Thank you. Good afternoon and welcome to our press conference. I'm joined here on stage by President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. As always, we are also connected to journalists who join us via WebEx. When we come later to the question and answers, I would ask the WebEx journalists to please turn on their cameras and their microphones so we can hear and see them. And now I would like to hand over to President Lagarde, please.
Thank you very much and good afternoon to all of you. The Vice President and myself welcome you to our press conference. The Governing Council today decided to raise the three key ECB interest rates by 50 basis points, and based on the substantial upward revision to the inflation outlook, we expect to raise them further. In particular, we judge that interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand and will also guard against the risk of a persistent upward shift in inflation expectations. Our future policy rate decisions will continue to be data dependent and follow a meeting-by-meeting approach. The key ECB interest rates are our primary tool for setting the monetary policy stance. The Governing Council today also discussed principles for normalizing the Eurosystem's monetary policy securities holdings. From the beginning of March 2023 onwards, the asset purchase program portfolio will decline at a measured and predictable pace, as the Eurosystem will not reinvest all of the principal payments from maturing securities. The decline will amount to 15 billion euros per month on average until the end of the second quarter of 2023, and its subsequent pace will be determined over time. At its February meeting, the Governing Council will announce the detailed parameters for reducing the APP holdings. The Governing Council will regularly reassess the pace of the APP portfolio reduction to ensure that it remains consistent with the overall monetary policy strategy and stance, to preserve market functioning, and to maintain firm control over short-term money market conditions. By the end of 2023, we will also review our operational framework for steering short-term interest rates, which will provide information regarding the end point of the balance sheet normalization process. We decided to raise interest rates today and expect to raise them significantly further because inflation remains far too high and is projected to stay above our target for too long. According to Eurostat's flash estimate, inflation was 10% in November, slightly lower than the 10.6% recorded in October. The decline resulted mainly from lower energy price inflation. Food price inflation and underlying price pressures across the economy have strengthened and will persist for some time. Amid exceptional uncertainty, Eurosystem staff have significantly revised up their inflation projections. They now see average inflation reaching 8.4% in 2022, before decreasing to 6.3% in 2023, with inflation expected to decline markedly over the course of the year. Inflation is then projected to average 3.4% in 2024 and 2.3% in 2025. Inflation, excluding energy and food, is projected to be 3.9% on average in 2022, to rise to 4.2% in 2023, before falling to 2.8% in 2024 and 2.4% in 2025. The euro area economy may contract in the current quarter and the next quarter, owing to the energy crisis, high uncertainty, weakening global economic activity, and tighter financing conditions. According to the latest Eurosystem staff projections, a recession would be relatively short-lived and shallow. Growth is nonetheless expected to be subdued next year and has been revised down significantly compared with the previous projections. Beyond the near term, growth is projected to recover as the current headwinds fade. Overall, the Eurosystem staff projections now see the economy growing by 3.4% in 2022, 0.5% in 2023, 1.9% in 2024, and 1.8% in 2025. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Turning to the economic activity first. Economic growth in the euro area slowed to 0.3% in the third quarter of the year. High inflation and tighter financing conditions are dampening spending and production by reducing real household incomes and pushing up costs for firms. The world economy is also slowing in a context of continued geopolitical uncertainty especially owing to Russia's unjustified war against Ukraine and its people, and tighter financing conditions worldwide. The past deterioration in the terms of trade, reflecting the faster rise in import prices than in export prices, continues to weigh on purchasing power in the euro area. On the positive side, employment increased by 0.3% in the third quarter, and unemployment hit a new historical low of 6.5% in October. Rising wages are set to restore some lost purchasing power, supporting consumption. As the economy weakens, however, job creation is likely to slow and unemployment could rise over the coming quarters. Fiscal support measures to shield the economy from the impact of high energy prices should be temporary, targeted and tailored to preserving incentives to consume less energy. Fiscal measures falling short of these principles are likely to exacerbate inflationary pressures, which would necessitate a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded rapidly. On inflation now. Inflation declined to 10% in November, mainly on the back of lower energy price inflation, while services inflation also hedged down. Food price inflation rose further to 13.6%, however, as high input costs in food production were passed through to consumer prices. Price pressures remain strong across sectors, partly as a result of the impact of high energy costs throughout the economy. Inflation excluding energy and food was unchanged in November at 5%, and other measures of underlying inflation are also high. Fiscal measures to compensate households for high energy prices and inflation are set to dampen inflation over next year, but will raise it once they are withdrawn. Supply bottlenecks are gradually easing, although their effects are still contributing to inflation, pushing up goods prices in particular. The same holds true for the lifting of pandemic-related restrictions. While weakening, the effect of pent-up demand is still driving up prices, especially in the service sector. The depreciation of the euro this year is also continuing to feed through to consumer prices. Wage growth is strengthening, supported by robust labour markets and some catch-up in wages to compensate workers for high inflation. As these factors are set to remain in place, the Eurosystem staff projections see wages growing at rates well above historical averages and pushing up inflation throughout the projection period. Most measures of longer-term inflation expectations currently stand at around 2%, although further above-target revisions to some indicators warrant continued monitoring. What about risk assessment? Risks to the economic growth outlook are on the downside, especially in the near term. the war against Ukraine and its people remains a significant downside risk to the economy. Energy and food costs could also remain persistently higher than expected. There could be an additional drag on growth in the euro area if the world economy were to weaken more sharply than we expect. The risks to the inflation outlook are primarily on the upside. In the near term, existing pipeline pressures could lead to stronger than expected rises in retail prices for energy and food. Over the medium term, though, risks stem primarily from domestic factors such as a persistent rise in inflation expectations above our target or higher than anticipated wage rises. By contrast, a decline in energy costs or a further weakening of demand would lower price pressures. Let's look at the financial and monetary conditions. As we tighten monetary policy, borrowing is becoming more expensive for firms and for households. Bank lending to firms remains robust as firms replace bonds with bank loans and use credit to finance the higher cost of production and investment. Households are borrowing less because of tighter credit standards, rising interest rates, worsening prospects for the housing market, and lower consumer confidence. In line with our monetary policy strategy, twice a year, the Governing Council assesses in depth the interrelation between monetary policy and financial stability. The financial stability environment has deteriorated since our last review in June 2022, owing to a weaker economy and rising credit risks. In addition, sovereign vulnerabilities have risen amid the weaker economic outlook and weaker fiscal positions. Tighter financing conditions would mitigate the buildup of financial vulnerabilities and lower tail risks to inflation over the medium term at the cost of a higher risk of systemic stress and greater downside risks to growth in the short term. In addition, the liquidity needs of non-bank financial institutions may amplify market volatility. At the same time, euro area banks have comfortable levels of capital, which helps to reduce the side effect of tighter monetary policy on financial stability. Macroprudential policy remains the first line of defense in preserving financial stability and addressing medium-term vulnerabilities. So, summing up, we have today raised the three key ECB interest rates by 50 basis points, and based on the substantial upward revision of our inflation outlook, we expect to raise them further. In particular, we judge that interest rates will still have to rise significantly, at a steady pace, to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand and will also guard against the risk of a persistent upward shift in inflation expectations. Moreover, from the beginning of March 23 onwards, the asset purchase program portfolio will decline at a measured and predictable pace, as the Eurosystem will not reinvest all of the principal payments from maturing securities. Our future policy rate decisions will continue to be data-dependent and determined meeting by meeting. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term inflation targets. And we now stand ready to take your questions.
Thank you, President Lagarde. And the first question today goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much, President Lagarde. I have two questions, obviously. First one on the
What do you mean, obviously?
well, we needs to take the opportunity, right? One on the significantly higher rates at a steady pace. Does that mean we are going to see more 50 basis points hike in the future? And how many do you envision if you see significantly higher rates? And on QT, quantitative tightening, how do you decide which bonds or which one do you reinvest and which not? Is there also a metric behind? Thank you.
So thank you for your two questions. On the first one, I'm glad that you picked up the key messages that are really embedded in this monetary policy statement that I have just read for you. And one of the key messages, in addition to the hike that we decided today, is the indication that not only will we raise interest rate further, which is something that we had said before, but we also say that today we judged that interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium term. I'm reading straight from the monetary policy statement, first paragraph, because that is the one that really includes the three key messages, the four key messages actually that we have. And one of them is that we, at this point in time, expect and judge that we will have to raise interest rates significantly. Now, what does that mean? You have to read it together with the steady pace. And it is pretty much obvious that on the basis of the data that we have at the moment, significant rise at a steady pace means that we should expect to raise interest rates at a 50 basis point pace for a period of time. The second element that you have in this paragraph is the reference to a steady pace. So it's significant and it has to be a steady pace, which means that we have made progress over the course of the last few months, but we have more ground to cover. We have longer to go, and we are in for a long game. On your second question, which is relating to the second part of our decision about the quantitative tightening or the reduction of the size of our balance sheet, where we decided the key principles, so predictable, measured, and we had said that at this particular meeting we would come with key principles. Clearly the first principle is the starting point, which we have agreed would be early March 23, and we have also agreed on the monthly average calculated over a period of 4 months until the end of the first quarter. After that, as indicated in the monetary policy statement, we will reassess and we will determine what is the appropriate pace at which we continue this process. Why did we pick 15? It represents roughly half the redemptions over that period of time. So it seemed, based on the advice that we received from our market people and all those involved in the decision-making process, which includes all the national central banks, by the way, on this occasion in December, it seemed an appropriate number in order to normalize our balance sheet. Bearing in mind that the key tool is the interest rate.
Thank you, Madame Lagarde. The next question goes to Alex Weber of Bloomberg News. Alex, please.
Good afternoon. Thanks very much.
Good afternoon.
So you said interest rates are going to have to rise for a period of time. investors currently expect a terminal rate of about 3%. Does that sound reasonable to you? Is that in line with what the Governing Council had in mind with the statement? And then on quantitative tightening, I'm curious, what will determine the correct pace of APP in the future? Is it all about the inflation outlook, or is it more a question of what the market can digest? Thank you.
I'll start with your second question. You know, these two components of our monetary policy decision today are of a different nature. We clearly see the interest rate as the primary tool intended to fight inflation, to tame inflation, and to return it to 2%. The quantitative tightening is working sort of not in the background, but is working to complement, to align with our key monetary policy tool, which is the interest rate. So there is no element of monetary policy stance, so to speak, associated with the reduction of the size of our balance sheet. On your first question, I'll say this. Our staff projection that embed and incorporate the market expectations of our terminal rate do not certainly allow a return to the 2% inflation target that we have in a timely manner. So, more needs to be done, and as a result, new market expectations will hopefully be embedded in future staff projections, which will indicate that we can reach the 2% inflation target timely.
Thank you. And the next question goes to Aude Kerselec of BFM Business.
Good afternoon, Madame Lagarde.
Good afternoon.
You stated in a recent opinion that gas price regulation could put at risk financial stability and be counterproductive. Could you explain why this mechanism would increase margin calls and volatility, because this is not necessarily logical? And if the proposed mechanism is not efficient, what will be your solution for an energy price cap? And second question, how do you approach this unprecedented phase for the ECB, the quantitative tightening of the balance sheet? How do you predict investors' reaction? Thank you.
You ask a question about the opinion that we released at the request of the Commission and in accordance with the treaty provisions, which predicate that the ECB, when consulted, has to issue such opinion. So we did so, and we did so taking into account financial stability principles, which is what we were consulted about, as well as the exact definition of the role of the ECB in respect of the gas price mechanism that was submitted to our review. I would refer you to the legal opinion. Suffice to say that one of the considerations in the legal opinion that was issued has to do with the fact that there is a clear risk of pushing out of the derivative and clearing system, which functions as it does. Is it TTF or TFF now? It's TTF, that's right. So the TTF has its own method of operations, but at least there is a degree of information that is available and that can be used. The risk is in our view, based on financial stability perspective that we take, that there could be transactions that would move out to much darker corners with a lot less information available that would then certainly cause some financial instability. And separately from that, we have also opined on the fact that the ECB can be consulted, but is not a member of the operation and cannot have an active role in that process, because it is part of the ECB to be an independent institution and not to participate in such a mechanism, which leads me to tell you that I don't have the solution, because it's not for us to find the solution. How do we address this QT program that we have discussed now extensively within the Governing Council, and that will start in March. We believe that it is totally legitimate, appropriate, and actually efficient to go in the direction of reducing the size of our balance sheet, to do that in a measured and predictable way so that markets appreciate and assess how it is going to unfold, at which pace, in what volumes, and there will be many more details that will be made available, including composition, classes of assets, permutation between them eventually, the greening and the green tilting of it, that will be released at our next Governing Council meeting in February.
Thank you. Turning now to WebEx, I'd like to ask Francesco Canepa of Reuters to ask his question. Francesco, please.
Good afternoon, everybody. So a question about the meeting. Did the Governing Council discuss a bigger or a smaller rate hike than the one it was approved, and a faster or slower pace of QT than the one that the question is about the reaction function? What do you need to see before you stop rate hikes? Give you an example. Your colleague and fellow countryman, Villeroy de Gallo, said he needed to see a turning point in underlying inflation, positive real rates across most maturities, and anchored inflation expectations. Do you broadly agree with him?
Thank you for your two questions. On the first one, I'm very pleased to tell you that there was general consensus around the table about the assessment of the current economic situation and general agreement about the orientation that we have and the strategy, which is to decisively, with determination and perseverance, to return inflation to 2% and to use all the tools that are most appropriate to that end. Not everybody agreed on the actual tactics. And I think that there was a very broad majority to support the view that we should show perseverance, move at a steady pace, stay the course to cover the ground that we have to cover. So you will be doing your digging and your asking and all the rest of it. But I can assure you that in terms of strategy, in terms of direction, in terms of orientation, there was total agreement on the part of the governing councils. Some might have wanted to do a bit more, some might have wanted to do a bit less, but eventually we coalesced with a very broad majority around the decision that you have in front of you. On the other question that you asked, I just want to take you back to the four messages, because I think that one of them is clearly important. And I will take again the first paragraph that we have in the monetary policy statement. We say, we judge that interest rates will still have to rise significantly. We had some clarification on the significantly, at a steady pace, to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. And then, keeping interest rates at restrictive levels will, over time, etc. So this is the fourth message that we are releasing in that paragraph, which is that we will sustain the course. It will not be enough to, hit and withdraw. We will sustain the course because we want those levels of inflation to remain at those restrictive levels for long enough so that we can be confident that inflation returns to target. Thank you.
Thank you. And another question from WebEx, turning to Domenico Conti of ANSA. Domenico, your question, please.
Hello, thanks for taking my question. I'm sorry for not appearing on video. I cannot find the right button to push. My question is about the ESM, actually. It seems that the Italian government is poised to be the only Eurozone government which won't ratify, at least anytime soon, the reform of the ESM. And some in the government claimed recently that the ESM in its current form has become an obsolete instrument. So would you like to comment on this, taking into consideration also that the ESM, of course, is a key to activation of OMT? Thank you very much.
Thank you very much for your question on the European Stability Mechanism. My understanding is that the case that was pending before the German Constitutional Court has now been settled, and that Germany is now in a position to ratify, which, as you say, leaves Italy as the outlier who has not yet ratified. You know, from a European Central Bank point of view, and bearing in mind that we have long advocated completion of banking union, obviously we hope that the ESM ratification by Italy will come in short order, because that would then enable the ESM to play its role. On the relation between the ESM and OMT, my understanding is that under its existing principles and under the existing governance of the ESM can be activated if and when necessary in relation to OMT. So it's not as if there was no governance in there. The ESM has a governance and can operate, including in relation to OMT, which is obviously one of the tools in the toolbox that we have.
Thank you, President. The next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, President Lagarde. Two questions for you. First one is, in your growth forecasts, you're forecasting that growth will return to the historical run rate that the Eurozone has grown at in the past. Why do you think that's likely, given all of the structural changes that are happening in the economy and everything that's happened this year in terms of the energy crisis, etc.? Second question is about central bank losses. Many national central banks are warning that they will make significant losses this year and in the coming years ahead as interest rates rise. Do you think it's sustainable for Eurosystem national central banks to run with negative equity? And would that be a situation that is sustainable? Thank you.
Thank you very much for your two questions. On the GDP projections that we have, as you said, slightly updated 2022. We have downgraded 23 by 0.4%, if I recall, and we now have growth at 0.5. And then we have 1.9 followed by 1.8%. So there is no upgrade or downgrade of those projections, and we believe that after this, a number of phenomena have faded, growth will actually return. And let me give you a couple of examples of those factors that will fade. One is, comes to mind, which has been impacting both GDP and inflation, is the supply chain and the bottlenecks that have prevented operations from functioning properly, and which is obviously fading out significantly at the moment. I think one question mark that we need to have on our mind is what happens to China and what role will China play in that context, which will be very interesting to monitor and to also assess as well. Another reason why we are offering those, staff is offering those projections, has to do also with the strength of the labor market and the fact that we are currently at rock bottom unemployment rate for the euro area, and that given the shallow and short-lived recession that we anticipate at the turn of this year, these employment numbers should remain high and participation should continue to increase. There is clearly a question mark as to how the energy market is going to pan out and how our economies in 3 years' time will develop new ways of operation, will go into renewable energy, sources of energy, hopefully, and what impact the price of LNG will have on us, and what kind of substitution we will benefit from in the very sad assumption where the Russian weaponization of fossil fuel was to continue. But all in all, we believe that this 1.9 followed by 1.8, which is roughly the growth rate that we had previously for the euro area, has chances to return, and recovery would come after the short and shallow recession that we anticipate at the turn of the year. Now, you also asked me on the central bank losses. And some of them, you know them well, have already indicated and have already communicated to their parliaments or to the markets, because some of them can be public entities or can be owned by stakeholders that are not necessarily the state represented by government, have already gone public to indicate how much losses they will be generating and what will their capital look like. And each and every of those national central banks is going to have to look at its balance sheet, is going to have to look at its equity, and is going to have to operate on the basis of the legal framework and the governance that is applicable. It's going to be different whether you talk about the National Bank of Belgium, or whether you talk about Banca d'Italia, or whether you talk about the European Central Bank. So I don't have a sort of general framework that would apply to all of them, because they're all different in essence. But I think when you look at the at history and what has happened to other banks around the world, central banks can actually operate despite being in a loss position, and some of them have operated with negative equity as well. So clearly, each and every national central bank will have to comply with its set of rules and regulation, comply with its governance, and that's what will happen. My understanding is that at the moment, many of them have accumulated sufficient buffers or sufficient provisions in order to go through the current crisis. But as I said, each and every one of them is going to be different.
Thank you.
They have historically generated quite a bit of profit, so there is a rebalancing act in a way which is taking place now.
Thank you, President. And the next question goes to Christian Siedenbiedel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you. Do you think that inflation rate will already fall in December? And do you think it will be more difficult to go on hiking rates if inflation is falling in the future?
Well, thank you for your question. It may well be that the December number of HICP and possibly core inflation be a little bit lower. But we have good reasons to believe that January and February, for instance, are likely to be higher. So we cannot be fixated on one single number. We have to look at a trend. We have to look at the inflation outlook. We have to consider what has been achieved and certainly where we want to go, because for the moment,